All right, good morning, everybody. Apologies, I know you guys were expecting me here at the top of the hour and didn't make it. Technical difficulties. We're getting them sorted out. We're going to start today with the number 0. That's how much tungsten Britain is under contract this morning. Yesterday, the National Wealth Fund agreed to put £36 million into Tungsten West. That gets Britain a stake in the company, governance rights, and a seat at the table. But the metal itself, that's still a negotiation. Nothing signed. And that's the difference between owning influence and actually securing supply. Today, that distinction shows up more than once. This is Universal Asset Owners Live. I'm Ryan Lafield. Today is Wednesday, August 26th. Let's get into it. Today is really about the difference between what a headline suggests and what is actually committed. We've got that in Britain's tungsten deal, and capital that has been announced but not yet deployed, and even in the way investors are reading yesterday's Treasury auction. So we'll start with what Britain actually bought and what it still does not have. Then we'll follow the money, look at the risk sitting underneath Europe's gas picture, and also, there's a market signal that gets very easy to misread if you stop at the headline number. So here's the big one today. As I mentioned at the top, Britain's National Wealth Fund is putting £36 million into Tungsten West, the company restarting the Himerton tungsten and tin mine. That buys 100 million new shares at 36 pence each, just over 7% of the voting capital. And with that stake comes more than just ownership. There's a board nomination, information rights, and limited vetoes over changes to the business plan and the issuing of new shares. Now, this is where the headline gets a little slippery. You may see a figure of up to £71 million attached to this deal, but £71 million is the ceiling. £36 million is conditional equity. £25 million is a proposed loan with no definitive agreement yet. And the final $10 million is an uncommitted accordion. What that means is that £71 million headline is doing a lot of work. These are 3 different pieces with 3 different levels of certainty. Goodness. So the money that's actually subscribed today is the £36 million, and even that is conditional on the new shares being admitted to trading. The proposed loan is interesting for another reason. It would start at roughly 9% at filing and then get 1 full percentage point more expensive every quarter. In other words, delay has a price. And then we come back to the tungsten itself. Britain has a limited period to negotiate an offtake covering up to half of projected output. No price, no volume, nothing signed. So the structure gives Britain influence, visibility, and leverage, but supply still requires a contract. All right, let's put one piece of this into plain English. What exactly is an offtake agreement? It's a contract to buy a set share of mine's future production before that production actually comes out of the ground. The price, the volume, the quality, and the delivery terms are agreed in advance. And this is the distinction that matters here. Owning part of the mine does not automatically give you the metal. That's the split in this deal. One piece gives Britain participation in the company. The other would give it actual contracted supply. And right now, Britain has the first. The second is still a negotiation. All right, let's follow the money today. 3 moves this morning, and the common thread is that the headline number is ahead of the cash. First, Sun Life and Windsor Re have signed a deal to create Windsor Life Re. The partnership expects to deploy about $900 million and begin by reinsuring roughly $1.7 billion of existing American life insurance obligations. Windsor Re is owned by CPP Investments, while Sun Life's SLC Management will run the assets. Launch is expected in the first half of next year, subject to regulatory approval. So this is less about money already deployed and more about the structure being put in place. Capital, insurance risk, and asset management all being brought together before launch. Second, Granite Asia's Libra hybrid private credit strategy has now passed its $500 million target. Its anchor investors include Temasek's credit platform, Malaysia's Khazanah, and the Indonesia Investment Authority. But this is a milestone above target, not a final close. And third, ADQ's offer for the remaining stake in AD Ports stays open until the middle of September. There's no minimum acceptance threshold, no squeeze out, and the shares remain listed either way. 3 moves, 3 very different structures. And in all 3 cases, the status of the money matters just as much as the size of the number. All right, risk radar today. Europe's gas cushion is thinner than it was a year ago. European gas storage is sitting at about 63% full. At this point last year, it was closer to 76%. That doesn't tell you there's a crisis, but it does tell you Europe is heading toward the colder months with less stored gas underneath it. And Qatar matters here because it supplied nearly a fifth of the world's LNG last year. Recent shipping data points to a major disruption in Qatari cargoes earlier this year, although loadings have improved from those lows. So the point isn't to treat one shipping estimate as a live reading of today. It's that Europe has a smaller storage cushion while one of the world's biggest LNG suppliers has already shown how quickly flows can be disrupted. There's also a sanctions piece worth watching. Washington created a new authority this week to impose sanctions across 5 Iranian sectors. Created the authority. It has not exercised it against an institution yet. And on the Strait of Hormuz itself, we're not calling it closed. Official descriptions differ, and there has been no navigational authority closure notice. So this is one of those days where the distinction between exposure and confirmed action really matters. All right, one more term from that tungsten deal that deserves 30 seconds. What exactly is an accordion? It's an option to make a loan larger later on terms that still have to be agreed. It is not committed money. So when you see that £71 million headline, this is why the breakdown matters. Again, the $36 million is conditional equity, the $25 million is proposed, and the final $10 million is the accordion, still unconfirmed. So the cleanest way to think about this, is this. The ceiling may be £71 million, but the ceiling is not the commitment. And that distinction is doing a lot of work in today's story. Here's a number that gets very easy to misread. The Treasury sold $69 billion of 2-year notes yesterday. The auction stopped at 4.204%. Headline demand softened a little. Bid to cover slipped to 2.60 from 2.66 in July. But the buyer mix moved the other way. Indirect bidders took just over 65% of the sale, up from about 56% in July. And this is the trap. Indirect does not mean foreign. Treasury's own guidance says that category does not tell you where the buyer lives. It can include American asset managers, pension funds, and insurers. So what yesterday actually showed was stronger non-dealer participation. What it did not show was proof that foreign central banks suddenly stepped in. 2 different demand gauges moved in different direction. And that's why one headline number does not tell you who really showed up at the auction. One more signal before we head towards the close. CalPERS says it has moved away from the term ESG. The new phrase is sustainability integration. But the capital itself has not simply disappeared. The shift described in the interview is away from some EV charging and offshore wind exposure and toward solar, grid upgrades, data centers, and geothermal. So the language is changing. The capital is still moving toward infrastructure with a very clear delivery system attached to it. One caution here. CalPERS has not published a formal document recording either change. Its own website still carries an ESG page. So this is an interview signal, not a formal policy announcement. Two of the world's biggest long horizon funds are also dealing with a leadership question. Australia's Future Fund says Raphael Arndt will leave at the end of the year. He's been with the fund for almost 2 decades, the last 6 as chief executive. And he leaves after a very strong year. The Future Fund returned 14.8% and added 37.4 billion Australian dollars, taking the fund itself to a record 289.7 billion Australian dollars. One number to keep straight here, 289.7 billion is the Future Fund. 356 billion is all 7 funds managed under the same board. The search for his successor is already well advanced. And in Seoul, Korea Investment Corporation is publicly advertising for a new chief investment officer. Applications close September 7th, and the term is 3 years. So 2 very large pools of long horizon capital are heading into leadership transitions at the same time. Before we get to the back page today, here's 3 questions I'd be putting in writing this week. First, how much of the headline ceiling is actually drawable today, and what has to happen before the rest becomes real? Second, which decisions require the state's consent, and what does that do to financing flexibility? And third, if the government eventually takes up to half the output, what is actually left for every other customer? Price, volume, quality, transport. If those terms are not written down, you do not have supply. 3 simple questions, but they tell you very quickly what is real and what is still conditional. Before the back page, I forgot I need to do the allocation nobody made. FTSE's indicative September review would promote EasyJet and Ithaca Energy into the FTSE 100. If that's confirmed on September 2nd, replicating trackers tied to that benchmark will have to trade at the rebalance. No investment committee met. No analyst changed a view. The benchmark moved, and the money follows. That may be the most predictable order flow in Britain next month, and nobody actually chose it. Now, the back page. It says equity, the loan, the board seat, the veto, all checked in. The tungsten, still being negotiated. And somehow that feels about right for today. Before we wrap, a quick word on who's reading the Daily Brief. It now reaches 98% of the world's sovereign wealth funds, 18 of the 20 largest pension funds, all 10 of the largest charitable foundations, 85% of the largest family offices, and more than 100 billionaires. And if that's the room already reading it every morning, come be a part of it with us. The full Daily Brief is free at universalassetowners.com. Every figure we talked about today is there, along with the source behind it. If you're not on that list, come join us. I'm Ryan Lafield. Thanks for watching Universal Asset Owners Live. Again, I apologize for the late start today. Wherever in the world you're joining us from, have a great rest of your day. Keep looking for the signals, and we'll see you tomorrow.